Well, good evening, everybody. This is Price Headley along with Ken Calhoun, and I'm really excited to work with Ken and have Ken in with me tonight. And actually, we're going to make this part one of a couple-part series. Let me just first do a quick audio check on my mic, then I'm going to ask Ken to chime in here in just a few seconds. Let me first ask you all to type in where you're joining us from, if you can hear me okay. I am in Lexington, Kentucky, by the way, and it has finally hit spring and now almost summer in the mid-80s here in Kentucky. Good to see you, Lee from San Antonio. I bet it's warm down there. Lax, welcome in from Connecticut. Hope all is well up in the Northeast, as well as folks coming in from New Jersey, Texas, Florida, California, Denver, Colorado, and many, many more. Speaking of Colorado, I want to get Ken to do a quick sound check as well. Ken, can you hear us all right?
Hey, coming through loud and clear, and I wanted to say good night. I'm really thrilled to, good evening here, really thrilled to be working with Price Headley and coming here at you live from Colorado Springs, Colorado. So great to see hundreds of you here tonight.
Awesome. Okay, if you heard Ken okay, just type a Y for yes, and we're going to get rolling because we have a special kind of just get right to business approach here with you tonight, more than ever. We always tend to be, but good, all of you can hear Ken. And like I said, I really am excited to have Ken with us, so let's get rolling. Welcome, everybody. Price Headley, glad to be here with Ken Calhoun tonight we've talked for a number of years about all kinds of different trading strategies, and just saw Ken when I was last in Vegas at the Traders Expo back in the fall, and we had just a wonderful meeting. Said we need to do some stuff together because I really respect what Ken does to teach different trading strategies. In particular, we both shared a passion for breakout trading strategies, trend following. Ken and I both acknowledge this as secrets of success. I'm going to go for a half hour, and then I'm going to hand it over to Ken. So we're going to be on kind of hyperdrive tonight. So definitely, and I don't know if we're going to have time for questions tonight because we have so much content we want to share. But bottom line is we're going to get right into it. My piece of the puzzle, of course, is reminding you that everything we talk about tonight is geared for your information and education only. Nothing that we talk about should be construed as a specific buy or sell recommendation. Even though Ken or I may be trading it, we want to make sure that you know all the rules of getting in and getting out and how we would handle it, not just on the way in, but also on the way out. Remember to consult with your financial or tax advisor on anything that might affect your unique financial and tax situation. Okay, so I'm going to talk about two of my favorite breakout indicators, and kind of put the two pieces together and look at some current market examples. The first piece is how I launched BigTrends.com, and that's trading accelerations in stocks and then, of course, using options on those to get even more bang for my buck. One of the things that you'll note in any kind of a trend-following approach is that you want to find situations where you're starting to see speed of movement. You don't want to be on a slow boat. You want to find the faster rocket ships and space shuttle launches. Where do those things really take off? Obviously, it takes a lot of energy to launch a space shuttle, and of course, you're getting that catalyst from the ground up with a lot of fuel being expended to get that thing into the air away from Earth's gravity. It's the same thing with stock trends and market trends. You got to get some kind of catalyst for movement, whether it's earnings, whether it's technical breakouts, whether it's a management change, whether it's a new product at a company, or even analyst upgrades for the quick trades out there. So like a lot of you, I started trading with moving averages. But what I found was that I was missing the best stocks, the ones that were going more parabolic. I got started in trading fresh out of Duke University as a grad there and thought I knew it all. I had to learn a few lessons on learning how to cut my losses early in trading and learned that quickly enough to be around for the long haul here 25 years later. But the bottom line is, the best stocks are the ones we want to be on. The best ones don't give you that entry opportunity, at least based on the traditional moving averages. Ken and I have a lot of different ways we get back on the train. Today we want to focus on breakouts. So I looked at a lot of the adaptive bands. I looked at Bollinger Bands. I looked at moving average envelopes. I looked at Keltner channels, Bomar bands, you name it, all kinds of different bands. And what I found is there's a lot of uses for those, but they were helpful on the volatility side. They weren't so helpful on the trend following side. And so I stumbled across it and testing all these things and putting pieces together, this concept that I actually created. People said I should have called it Headley bands, but I actually wanted to convey what we're after. We're after acceleration. I'm not much of an artist, but rather than seeing you on much a slow boat that's gradually grinding higher, you know that can still cost you money as an options trader and even cost you opportunities as a stock trader. I would rather be on things that are starting to accelerate, starting to pick up speed so that you actually get more of a parabolic effect. So, we're going to look at a lot of current market charts here in this next short while before I hand it over to Ken at the at the half-hour point. But bottom line is, looking back, for example, at Apple Computer, and then I'll show you a current chart of Apple. These are the acceleration bands on the top panel. This is pulled off the Trade Monster platform. I'll also be using Trade Station live tonight. You can do this on a lot of different panels and find the acceleration band. So what we're seeing here is it defaults to my classic setting, which is looking back over the last 20 periods on the acceleration bands. Okay, so 20 is the setting. We're going to give you some nitty-gritty stuff you can use here for sure tonight, so you can go plot this stuff. Now, what I'd want to try to stay away from, especially if you're trading options, but even if you're trading the stock, is this slow grinding chop. You can see this kind of a WV back and forth pattern here is the kind of periods that you've got to be very careful to stay away from it. You think you can catch a little piece of the move, or you even think you can trade it off the bottom of the band, but sometimes it hugs the bottom of that band and it doesn't move fast enough. It just creates, especially in this little wiggle area here, that's options death. If you're buying options, you're in big trouble because it's not going to be moving fast enough. But really where this thing really starts to take off is, as you see, not just one, but a couple of breakouts outside in a row outside of the upper band here. This is going back to a prior move from a while back on Apple, but the bottom line is that was catching just one of many launch points to the upside. And so the sweet spot here, as you see this thing start to take off here, is really just in that window. There were a couple of other little tiny windows, especially the one back on the left side of the chart. That was a nice little run as well. So 2 out of the 3 of those moves were good. One of them would have stopped you out as it flipped back down. We'll talk about stop outs here as well. So part of what I want to allude to is that you can't expect perfection in any trading strategy. If you do, you're not going to be able to cut and run like you need to and move on if the trade's not doing exactly what it needs to do. The other piece we're going to talk about is the percent R rules here, that I call it the big trends way for Larry Williams percent R indicator. Not everything I use was developed by me. It's tweaked by me, but the bottom line is that I'll take good ideas from wherever they come, and you definitely want to stay tuned with Ken Calhoun's ideas as well. I can't wait to see what he has to share. I'm always learning from him as well. So let me share with you quickly what I'm using for the Williams percent R big trends way rules. Okay, percent R means percent range, by the way. We're trying to take a range of action, and it's very counterintuitive because these are trading what you think are the extremes, but they actually end up being very easy to follow trend-based moves. Now, percent R is like a stochastic or an RSI. Most people use it in a way that I don't think is the right way to use it. They look for a, quote, overbought market, and they try to sell an overbought market. But as you probably noticed in the last couple of years, when an overbought market went overbought, it stayed overbought a lot longer than you and I would have expected. Sure, there's been a little more chop here in 2014 so far, but there's been great trends even within that on whatever time frame you like to trade. And so these are acceleration bands, and so bottom line is that we're going to focus on how we set that up here in a second. Oversold, same concept. You think oversold, oh, it should be great to buy soon, right? That's what you've been taught. But guess what? In the financial crisis of 2008, when the financials started going oversold, we rang the bell on actually the first sector to start going oversold was subprime. We hit more than a doubler on New Century Financial, one of the first big subprime ones to go under, and then you started to see the domino effect hit across the financials, across the brokers, the banks, the insurance stocks, and then bleeding into the rest of the market to where we even made big money on puts on J&J, Procter & Gamble in the fall of 2008 because everything started to go oversold and more oversold. And people were thinking it had to balance, and they just kept getting pounded. So we're going to talk about how you can benefit from that. I use what I call a positive scale for percent R from 0 to plus 100. Not just because I try to think positively, but because I'm looking at more of a grade school scale. It makes more intuitive sense to me. So guess what? Well, I want to encourage you. I'm giving you some very specific details here. When you go plug it into whatever your preferred platform is, I use a 30-bar setting. You can use whatever you want, but I actually suggest that if you use a 10-bar or a 14-bar setting, you're going to whipsaw yourself too much at a time. I, like Ken, want to help you build your confidence. We both are big believers in education, and so the bottom line is that this is what I do. It's very different from the majority of traders out there. For a bull trend, believe it or not, I want to see the stock go overbought. We're going to get into some live charts here in just a minute, but I want to just lay some key groundwork so you can understand what we're looking at. Overbought in the top 20% of readings. So on a 0 to 100% scale, this would be above the 80th percentile. So if I tell you, for example, a stock's trading in a range between 100 and, say, 110, okay, so you say, well, gee, it's in 100 to 110 range. And so essentially I'm telling you it's got to be greater than 108 for me to get interested. You say, hold on, doesn't that mean you only have 2 points of upside potential and 8 points of downside potential? In a trading range, that would be true. But in a trend, what happens is that range is continually ratcheting up to the upside on your highs and to the upside on your lows. So actually, we're going to see that this is oftentimes the kickoff to even higher highs, even more opportunity. That 110 is not the true cap. Same thing on the bear side. On a bear trend, I'm telling you, be interested when it goes oversold for a breakdown strategy, and it starts to not just move into the bottom 20%, but notice my trigger here is it's got to then keep going down. It's got to tell me that, in my belief, the institutions are the ones driving the market, not you and me as individual investors and traders. If you're trading $10,000 or $10 million, we're still in the relative minority here compared to the institutions that are trading in the billions with a B, right? They're far eclipsing traders in the thousands or even the millions. And so the bottom line is we want to know where those big fish are going so we can piggyback along and get a piece of that trend as well, because they can't establish their position all at once. So it's got to close under that low to tell me it's starting to really move, in that case, to the downside. So, for example, going back to Apple for a second, we'll look at the current charts and start to even show you how I scan for these situations. Bottom line is, when Apple, you can see never was it going down and closing below that for 2 straight bars. You saw I got close. That was a flash crash of 2010. That's one of the reasons I like to keep that chart on there, because Apple hit down intraday at 200 and closed back at about 245. So it was a wild, woolly day there, May 6, 2010. I remember it well. Dow was down almost 1,000 points intraday. There were acceleration opportunities as the move started, with the Dow down about 150 on its way to down 998, hit the lows. Okay, so it was really a wacky downside move intraday. And there's opportunities if you're a day trader. By the way, I'm curious, if you're more of a day trader, tell me what type of trader you prefer to be. We don't have a lot of time for Q&A, unfortunately, but I can read out the general sentiment here. Day trade, swing trade, more of a position trade out 1 to 4 weeks. Tell us what type of trading style you like, because I'll show you some charts that fit the group tonight. So the bottom line is, let me go ahead and share with you, with %R rules right now, what's going on with Apple as we speak. I don't like showing you old charts. I like to show you new action. We've got a real mix here. Quite a few actually in the day trade camp, in addition to the swing trade camp. So that's the most popular, and a few in the position trade. Okay, but you want to pay attention here to the big picture trend, but then you want to tighten it up and follow the short-term trend. So you can see you might not be in these moves very long. You can see Apple gave a few of these breakouts on %R here. %R says if you go above the 80% reading, like back here October 15th, then we'll bring it up to current, that was at 502 on the daily chart. And then you see it's closing over there, and we're starting to get the confirmation as it's starting to move through that 502 area. And it surges up, not just outside the acceleration bands, which are in purple here, but also I've got some long-term Bollinger Bands I use to also tell me, are we outside of those as well, the light blue lines. Right now we are. This is a very powerful setup in the bigger picture sense, even though it's kind of pulled back a little bit the last couple of days. This is a very bullish chart still for Apple based on the %R and acceleration bands, to name just a couple of core starting points. So you can see that first move from 500.79, just under 501 on the buy signal, gave an exit at 521. Now that came about 2 weeks later. That's longer than most of you would like for you swing and even day traders. But you want to know that the wind is at your back on the big picture as well. Next buy signal here right at just under 550 on 11/29 into November last year. Ran from 550 to 575 over the next 5 days. Yes, it did eventually pull back to 555 as an exit. But the point is, that's why we're going to look at the intraday charts next. This move that just happened on Apple, let's zoom in for a second. This thing was dead money, you can see, for a while. It tried to give a sell. We were still above the long-term moving average in the light yellow line there. We were also holding the lower acceleration band. So guess what? Not as many pieces of the puzzle lining up in Apple's favor. If it's stuck at the top acceleration band in purple is resistance, bottom acceleration band support, I'm not going to try to fade that. I'm going to wait till it gets outside of it. You can see the big breakout that just happened was on the gap up on the earnings. Gap up on the earnings, I don't buy right there. I say, okay, fine. One bar does not make a trend. One candle does not make a trend. What I'm looking for, we'll get down to the intraday, don't worry, is the big picture saying, okay, this thing broke out on the gap up on earnings. 570 was the high. If it had not closed above 570, I would not be interested. That would be a one-day fake out move, and it'd be a risk of giving a chunk of those gains back quickly. Don't want to get faked out. We're trying to minimize the fake outs and be on the true breakouts for the real breakout success strategy. So 570 is the number. It's got to close over there, and there it is. The next day, 25th of April, a couple weeks ago, you see it closed 571.94. My system tries to be as real world as possible on any time frame in my testing and say, look, we want to buy the actual next bars open. So in this case, buying the next bars open here, 572.80. That day, it went from 573 to 595. Pretty profitable stuff when you then break it down to your intraday charts. Because then you see what's happening here on our intraday charts. If you're a swing trader, use the hourly chart as my recommendation, because what I find is that you see we catch the first little move up here. It's a little slow, and then the next one after the earnings gap you see kicks in at the end of that day. Even with a brief little pullback, it doesn't flush you out. So you've got to give yourself enough wiggle room to stay with the trend. And I know Ken and I have talked about position sizing strategies too. One of the things that I do is, you typically will start a position on a breakout at a half of what I would normally invest just to get it going. And then if I get what we call a retest, which we'll talk about in a follow-up session, bottom line is then I'll add to the position. You can see my first stop on the breakout would be, in this case, the first breakout bars low, which is in the neighborhood of about 565. Now, the bottom line is that you see it's getting the signal there at 569.66, just a little bit under 570, and you can see the very next day we're rocketing up. Look at what's happening to percent R. It is staying in the top 20% of the area here. You can see right before earnings it told you to hop out. That's okay. We wouldn't want to take a trade right in front of earnings as a straight buy. I do all kinds of other option spreads. That's for a whole nother time, or for our coaching sessions we do a big trends. But the bottom line is that what we're looking at here is just say get the stock right first. Then you can do all kinds of simple option strategies like buying an in-the-money option. If we're at 570, I'm probably looking at like the weekly options on the 565 or maybe even the 560s. The bottom line is you want to create a stock substitute and not have a lot of time risk. You can see where are you going to eventually get your exit here after a few days when we get our key test point back under that overbought threshold. That's the key low I use. I don't actually sell there. I say if it breaks and closes under that low, then I have to get out. That was 591.81, and it knocked us out at 590.16, or the next bars open, 592 actually, the next bars open. So the bottom line is not bad from 570 to 590 plus. Now, back to you day traders. For day traders, look at what's going on here. So you're getting the confirmation on the hourly. You're about to get it on the next bar here on the daily. But the 15-minute chart can even be speedier. You can see right after the earnings, we're breaking out, but we're not falling through initially. One of the key rules here, let me zoom in on that so you can see this a little bit better. On the 15-minute chart, you can see that, zooming it in, oh, wrong direction. Bottom line is that for a 15-minute chart trader, we want to make sure that it follows through. When it first gapped up, the first 15-minute chart high was 568.84. So it has to close above that typically in the next 5 bars, or else I'm not going to be interested. And you see it actually comes back down. It was giving a short before the earnings. We would not have taken that again before an event like earnings. Wait and see what happens after the earnings gap. In this case, the earnings gap high did not get initially taken out. So even though it's staying overbought, I couldn't buy because it didn't follow through fast enough. You have other opportunities for your capital. A big part of what you have to learn is how to rotate your capital into what's working and get the heck out of what's not working. So you see that we actually are waiting now for the next signal. You see that this one tries to go overbought again here the next morning. Doesn't follow through over that high on a closing basis. 570, it doesn't close over 570. And so we're waiting, and then patience is a virtue. When you do see it finally set up and then follow through, look at what happens here. Now let's zoom this in. So let's zero in on what happened here. Okay, so you're looking back at this, saying, okay, look, this thing finally breaking out over here. Why? Because it goes overbought. That high is what we're using, 570 again. Gee, you think the market has a memory for key numbers like 570? Absolutely. This is a 15-minute chart, remember, and then it closes above there, and we're breaking out just over 570, saying time to hop on board the Apple train here, and look at what happens. It's not just staying stuck at the highs there at 570. It's continuing to make a higher high. So the range is not fixed. That's a big lesson for a lot of people, that percent R just shows you that it's staying overbought as it absolutely launches. Notice as it gets through the acceleration bands here, it's launch central. And again, just it helps when you go through and actually experience this even before you're trading real money. Yeah, paper trading is one thing. It's not the same as real money, but it does help you when you're watching this bar by bar. And so sometimes zooming in, so look, I can see the retest is coming on that low back under the 80% line. That's at 585.45, the low. If it closed under there, I got to get out. Notice it traded under there the next bar. That flushes a lot of stops intra-bar, but it doesn't close under there. You stay with it based on the percent R rules. And look, okay, now it's going to give you another retest coming in right here, 586. It's tightened it up just a little bit from where it was back there, and then it does stop you out there at 585 that day on the 28th. So bottom line is, when you're looking across for these, you're saying, gee, this thing is really following through. So it has to close above that first bar's high. And the bottom line is that it has to do it pretty quickly. It doesn't have to happen in the very next bar, but it has to happen, in my view, in a tight window about 5 bars time. Now, when I'm going through and I'm looking for opportunities, and by the way, you can see on the daily chart here from a big picture perspective, yes, it's trying to give some sells here intraday on the end of the day today, gave a little retest. So it might still go through a little bumpiness tomorrow morning, but there's no way I would go short this because of the condition of the daily chart is so powerfully bullish still that I still expect Apple will probably test into this 80% level in the daily chart and then snap back up. Think of this. When you line up all 3 time frames, you're going to get yourself on the best odds of success. In TradeStation here now, what I'm doing is I'm actually looking at what I call radar screen. They call it radar screen. I just use it. But bottom line is I've set up my indicators like big trends on the percent R bull and bear trades to find what's really breaking out to the upside and what's breaking out to the downside. That's when it goes green here. So it's saying Pepsi this is a daily chart over here. We can change our intervals here in a second. And I know I'm hauling because I want to make sure Ken gets his full half hour too. So thanks for picking up what you can, and then we're going to give you continuing follow-on education that you can continue to learn from both of us over time. But bottom line here is that another one is actually the Dow, the DIA, the Dow Diamonds. Most of these are going yellow and they're not going to green. Yellow just means they're setting up. And then red means it's coming back for what we call a retest. So, for example, you look at a stock like Halliburton. That's the big oil services and construction company, but mainly oil related. And I can click on that and I can say, you know what, I know those intraday charts are going to look terrible on How. But the bottom line is that when I pop that up, I say, hey, this thing's been on a big uptrend. The last retest ended up being a pretty good one. It never violated. Well, does that mean this one's going to be ideal? Not necessarily, but what I know is today's low on Halliburton around 63 1/3 needs to hold on a daily close. Like I said, the whole market took a dive kind of late, didn't it? So bottom line is that, we can look at the condition of the Dow here in a second live, but you can see it was weak intraday. There's no way I want to step in front of that. I want to line up all my time frames. We mentioned the Dow is trying to give another buy signal. It's been a little choppy here recently because we're testing into old highs. Everybody keeps rah-rahing on CNBC about, ooh, new intraday high there. Well, guess what? It kind of faded off of there by the end of the day. Had a good jobs data reaction, good jobs data, I should say, last Friday, the 2nd, gaps up early and fades late. It's having trouble here. So, while it's saying it's going to give another bull confirmed signal based on the close above yesterday's high, we're saying, look, we'd like to go ahead and firm this up a little more with what's going on intraday. Right now, the intraday low on the Dow on the hourly was 165.29, and it did hold that. So that would be the hourly swing trader level I would use. You can see the quick trader should have been in late yesterday and out about early afternoon today. Okay, so the bottom line is that 15-minute chart's in a no man's land now. We wouldn't touch it. So we're looking at all these pieces here, and literally I would go from the daily. Let me look at the bear setups as well here. So flip it around. Remember, bear setups, we haven't talked about those as much, would be we're getting the bottom 20% of readings. So you look at some of the names like Amazon's been really weak, right? AMZN, CLF, Cliffs Natural Resources, some of those resources stocks. Google, you see GOOG now also has the GOOGL component. All these pieces, there's a lot more bears actually setting up than bulls, ironically. Whole Foods Market had a bad reaction to earnings, WFM. And then, of course, Priceline, also all over the place today. Again, that's one that we wouldn't necessarily trade because it was earnings coming into the day. We actually would, for option strategists, maybe look at a little specialty option strategy like a calendar spread. But the bottom line is that from a trend perspective, right in front of earnings, right near the long-term support. It did close underneath it, although you see it open down, close a little higher than where it opened today. Kind of a funky reaction, I'd have to say. So the bottom line is that you can see right now we'd be kind of steering clear of price line. But when you go back to where it was falling out of bed well before earnings a couple of days ago, you can see the 15-minute chart picked up a sell at 1180 that trended it down to 1138. That's a huge move. Obviously, the options are expensive in front of earnings, so you still do have some challenges as an option trader trading right in front of earnings because the volatility is just so high. You see the stock was down 18 points, but guess what? If you bought puts or calls on Priceline, you probably wouldn't have made a whole lot of money today because the options were juiced even more for more volatility than what you saw close over close. But, we look at all these pieces of the puzzle. I mentioned a couple others that we're just talking about on the bear side on radar screen. We mentioned, of course, Tesla had earnings today as well, but that one's just setting up. It's not actually bear confirming. Amazon's the one I wanted to look at, AMZN. So, for you weekly options traders, it's one of my favorites to watch along with Apple, along with Google, some of the big moves that we see. And Amazon is already broken. It came in for a test. It held that resistance around 310.48. Even though it went above their intraday, it never closed above that 310.48 number. So that's why we use the closing stop. And now you're back in business with the 15-minute and the hourly going short. That's going to be one of my prime bear candidates coming into tomorrow. Now, it may have, I think it has earnings up here soon, too. So we need to be careful on earnings. Make sure you don't step right in front of an earnings situation here, okay? So just always, I think it may already be out from that gap right there, actually. But, pay attention and make sure you don't step in front of an earnings gap situation. So from this perspective, what we're looking at is, I know I'm going fast. The bottom line is that we want to make sure that you're learning at least something here. So if you can only focus on one thing, I would say go with %R. Because literally what I can do now is I can start to radar screen on over into different time frames. So now I've started to build a watch list on the daily. Now I can change this, and I can literally say, okay, what about the hourly chart? Go show me where the 60-minute, all those key stocks are right now. It'll take just a moment. It pops up the update, and then I can literally go through and I can say, okay, then resort my window based on the 60-minute hourly chart. For you swing traders, this is the time frame that I'll use. So bottom line is that you look at this and you say, okay, gee, a lot of them were setting up and not really following through on the bull side. So fascinating that we really had no green on the bull side. That's a little telling, isn't it? Flip it over, and you say, whoa, we had a lot of bear confirmations late in the day because the market kind of flipped. Transocean Offshore had earnings, gapped up, failed, shot back down by the close. Might want to pay attention to that. You look at some of these others, Wynn Resorts, the casino operator, going bearish on the hourly, and Amgen also doing the same thing, the big biotech there. And there's Amazon. So guess what? We already saw Amazon was telling us that, but if you're not seeing it, you start to see it across multiple time frames. I can do the same exact thing now on the 15-minute chart for you quick traders coming into tomorrow. You're saying, well, are any of those setting up the same way on the 15-minute chart? And there's one green one there on was that CRM, Salesforce.com. When it goes from green back to red, that just means it's testing back above that oversold level. So if I click on Salesforce.com, again, make sure you don't step in front of earnings. This one may be a May earnings cycler. Just a couple more minutes and I need to hand it over to Ken, so I'm going fast, I know, but I'm trying to show you that, hey, it's not quite there on the hourly chart. See how the hourly is not quite there? You see the daily is also not quite there. So just because the 15-minute is indeed confirmed doesn't mean enough because the other ones are not quite where they need to be. But you can see, gee, look at that thing fell out of bed just a couple days ago. When these things go oversold, you'd think oversold stocks can't go down that much more. Wrong. You need to be ready for the bottom falling out. That's how we caught the financials breaking down like Bear Stearns. We caught from $69 as that thing went down sharply over the next week. Lehman Brothers, Fannie Mae, during not just the financial crisis, but during any kind of period of market panic. You can do the same thing looking at, of course, all the major indexes like gold, the GLD, and a whole lot more. And so the bottom line is that, right now you see gold's not giving that follow-through on the hourly. It's trying and it's failing. So that is the bottom of the range until that support just under 124 would break down. Yes, you had a quick trade from a 15-minute perspective yesterday. It's now over. You can see we're in a no man's land on the daily chart as well. Compared to, look at the great trade gold gave you earlier this year as we broke out in late January. Remember, the market had some trouble in mid to late January and early February. That pullback gave a little retest. I'll talk retest in our next follow-up segment. But the bottom line is you can see it catches and then it holds that retest. It takes off, stays overbought until it finally ends on that retest failure right there at the close on the 19th, telling us to exit then at the next bar is open. So bottom line is this will keep you on the right side. And again, if you want more follow-on education from me, definitely go to this special page that we set up for you for free education. If you're new to Big Trends and I went too fast, go to bigtrends.com/free and you can get access to that. And now what I want to do is I want to hand it over to my friend Ken Calhoun and make sure that he can also share with you his perspective on breakout success strategies. So I'm really excited to have Ken with us, and again, he gives you hard-hitting real-world trading too. So Ken, go ahead and take it away.
Hey, all right. Thanks so much, Price. It's been an honor to work with you. I've been a long fan of yours for many years. I was taking notes. Two of the things that we both do, which I made special note of, is it looks like you look at Williams percent R overbought over 80%. I use the ADX line overbought, and I buy that on strength too. So it's neat to see the synergy there. We both have similar tactics for that. And we also like gap continuations and position sizing, and we wait until the day or two after the initial gap to get into breakout trades. So really good synergy there, and good to be working with you. I'm very selective about whom I work with, as many of you know. Hundreds of you here tonight. Price Headley is one of the very best educators in the top 5, in my estimation, in the whole industry. So it's a real honor to be working with Price. He's one of the sharpest, best guys to learn from out there. So a real pleasure to share the stage with you here tonight, Price. Well, let me go ahead and jump into it. Winning breakout trade strategies. We're going to take a look at many different entry and exit techniques using live market charts tonight. My quote of the week: successful people are simply those with successful habits. Here I am with Brian Tracy. For those of you who are new to working with me, you may have seen me in stocks and commodities, active trader, speaking at the Money Show Traders Expos, doing my own events in Las Vegas, and the rest of it. Let's jump into it. Successful trading is a lot more about the math than it is the chart patterns. And what you're going to learn tonight is the first of 2 parts. We're going to look at some professional breakout strategies. I've traded millions of dollars worth of stocks and ETFs, and one of the things that I found neat was that Price and I both like to trade some of the same instruments. A lot of the ones in his list are in my own professional watch list as well in terms of things that I trade. So we're going to look at 3 main strategies tonight for professional trades. We're going to focus on the swing and longer term 90-day chart tonight. We're going to tighten it into intraday charts like AIG. I posted long calls for my traders today in my live room at where we go in long at 51.80 and again at 52.20. We're going to do more on intraday next week. But tonight I want to go ahead and get started with some of the very best of the charts out there and give us some of the strategies that you can start using in your own trade. So let's take a look at exactly what the rules are. I like to use 90-day daily candlesticks and 15-day 15-minute candles. I use a maximum 1.5 point stop and trailing stop. I scale in roughly every 2 points on swing trades. And criteria of what I like to trade, and I was pleased to see a lot of overlap between the ones that Price and I both trade. I like stocks and ETFs priced between $20 and $70 a share, trading at least 1 million shares a day on volume. Now let's take a look at 3 different strategies, and kind of that's about it for my PowerPoint. So we're going to spend the night looking, or next 25 minutes looking at live charts. The first strategy I want to teach you is my favorite one. I've traded this many, many years, over 15 years now. I like using wide range momentum candles at the right side of major cups. Okay, so when you see a cup pattern on a 90-day, you can start using these. Whether you're an options trader, you're trading the underlying like I like to do. We like to look at wide range momentum candles to get. Remember that I like that slide from Price where he had the rocket taking off. Well, I like to look at candles for momentum breakouts and to look at the very best of those charts. Let's take a look at this pattern and what to look for. And I've spoken on this at Money Show, and I've trained thousands of traders. Look for a sequence. And you can do this without any special scanning software. Visually on a 90-day, even if you're a day trader or short-term 3 to 5 day swing trader like I am, or up to a couple of weeks, look for a 1-2 candle pattern, or the whole real body is at least 1.5 to twice the previous candle's body. That's a momentum breakout. You buy the day after that. The other pattern of that constellation is a wide range candle at the right side of a cup. So if you're going through your charts and you're looking for a cup breakout, whether you get in on an early cup with a wide range candle or a secondary cup, that's a very good, very effective, you have my word, I've been trading this for many years, very good strategy for what to look for. Here's another good example of a wide range candle. You have a cup pattern in an uptrend. We've got high volume with that wide range candle. If you're like me, odds are you missed it, but at least you're following up. Let's say you're scanning, and we go old school here and just put up a notepad file, the passage of time. We're going by tick tock, tick tock, tick tock. When do I buy this thing? I don't, oh, okay, that got my attention. We got a nice big volume. Now what do I do? Question mark. Put in a buy stop order. I use buy stops in my Interactive Brokers at Fidelity accounts. So, 50 cents above that wide range candle high to get in on a breakout. And even if you miss the first one, odds are volatility leads to additional volatility. You'll get sequential opportunities. I'm a big fan, as is Price, of doing the trend continuations for the strongest of the charts. The trick is avoiding false breakouts. This is a simple visual filter you can use every time you trade. Just look for a cup pattern. Don't get in too early. Wait until you have a candle at least 1.5 the whole real body height of the previous one. If it's piercing a major moving average line, even better. I use the 50, 100, and 200 simple moving averages on the 90-day. We'll drill down into shorter term charts as well, and you're off to the races. Here's another good example of that same exact chart pattern. You've got a cup, and aha, there's a wide range candle. So let's say something's under surveillance. You're watching it, wondering where to buy. I'm not a pivot trader. I'm a breakout trader. I'm a professional breakout trader. I'm widely recognized as one of the world's top breakout traders. Anyway, I'm looking for these kind of wide range candles, a sign that institutional guys are coming into this instrument, and then I'll buy the day after if it's at least 50 cents above that. So you don't buy the move down. You wait until, okay, there, okay, which is today. So we'll see how that works out between now and next week. But MNK, if you pull up a shorter term swing chart like this, you can see this is a nice 45, almost 45 degree uptrend continuation, higher highs and higher lows. The range is 60 to 78. That's part of the challenge as a trader, is make sure that you're focusing on these widest range, best trending instruments visually before you put up a, put together a trading approach. So here's the last example I have for you of that particular chart. I always buy gaps up the day after the gap up, right, or the day or two if it's taking out new highs. You don't buy the gap up day. Usually I'll get in, and you often won't see it, to be honest, just from a workload standpoint. So what you do is you buy the day after the gap or a wide range candle at the right side of a cup. Okay, so that's a simple pattern that I want you to start testing. I encourage you to test. That's when I tell family and friends and thousands of traders around the world that trade. Wide range momentum candle at the right side of a major cup. Okay, that's a simple one to look for. Here's number 2. And I like what Price said. He has acceleration bands. I use what's called visual acceleration ramps. Looks like a hockey stick. And visually, this is a very good professional price action based trading strategy. We're looking for uptrends that go from strong to stronger recently on higher volume. It's a good classic day trading and swing trading strategy. Let's take a look at some acceleration ramps. Let's see if you too can spot the ramp. Looking for a narrow congestion, not really blowing my hair back yet, but aha, there's a wide range candle. So what do I do? And again, let's simulate the passage of time. Tick tock, tick tock. Yeah, it's on an uptrend. I don't know if I want to buy it. I'm not really excited about it. But aha, that has my attention. I probably missed that day. I found it in one of my evening scans. I scaled in starting the 50-cent breakout above that. Okay, and the acceleration, does everyone see it? Narrow slope, large slope. Now, there aren't any specific rules about it's got to be, 16.5 degrees or 45 degrees exactly. All you want to do as a good trader is get in the ballpark of a good breakout that's likely to continue professionally, whether you're looking for cup breakouts, if you're looking for reversals, if you see a bullish lower shadow or a hammer at a low. This isn't a hammer because it's not at the low. For more on candles, learn from Steve Nissen, my colleague. But anyway, look for these wide range candles. That's great. Can everyone spot that? Wide range momentum candle on a daily chart, even if you trade off the intraday charts or you're trading off of a shorter term swing trading chart. Let's look at 4 more quick examples. Now here's one to be cautious about, right? You might get all excited, but don't This is PDI. This is a really nice looking chart, but what's this one? This one's doing a deceleration ramp. It's going from a sharp angle break to a narrower angle. So I'd still buy the new high, but the control measure for getting to avoiding false breakouts is if you get smaller whole real body candles or the slope of the line is slowing down a bit, it's putting on the brakes. And if I had the ADX line, you'd see likely the Wilder's average directional index likely trending down. So stay clear of, you still want to, I would still buy this over 33, say 33.5. Again, not a trade recommendation. This is all for educational use only, but I would buy 33.50. I would do so though on lighter share size. So instead of say, 100 shares, I might do 20 or 50 shares just to do a pilot or test trade, right? Here's another good example of an acceleration ramp, PPC the ticker. This one did kind of the mother of all trends, nice wide range, finally took out the cut pattern high, putting in new highs, and the angle of this breakout range is sharper than that. So this is classic price action based swing trades, looking at a slow range that then moves to sharper ranges. And just two more quick examples here for acceleration ramps. You have a narrow range. Always buy gap up. There's rules to that. I usually like 5% or less of a gap. I don't buy big, huge gaps, but if it's 5% or less, I usually go in trend of the gap. I always buy gaps up. I always short or sell gaps down, right? That's the right way to trade. That's what any of my Wall Street guys, any of my professional traders, my prop shops, or my institutional clients would tell you. That's institutional buying volume, so why would you not want to buy new highs? So getting into trouble here, it's doing a quick reversal. We've got a bullish lower shadow there with support. Anyway, the point is this one's in play. I would buy this over, say, 40.5. The 1.5 point stop. I would double the trade up at, say, 42.5 for a swing trade. We'll cover intraday trading and precision trading in the next event. This is part 1 of 2. This is to be continued. But anyway, one thing I like, too, is that Price and I have very similar patterns in terms of the things that we look for. And we have very good, this is my professional quote box of things I like to trade. And we both trade a lot of the same instruments. So I like that. That's another good point of synergy. I always learn from the best people that kind of agree with each other and get their take on it and build a systems approach. In your trading plan, take a few bullets from what you learned from Price both tonight and next week, and also what you learned from me, and then develop and test it out yourself in the anvil of the marketplace. Anyway, XLE, here's another one. Narrow range, wide range breakout. So that's an acceleration ramp. That's strategy 2 of 3. I'm sorry. We're not done yet. So wide range momentum candles at the right side of a cup is one easy pattern to look for. Another is these acceleration ramps. The third one are gap continuations with cups and candles. And I've got a few charts here for you to look at. And then we're going to drill down into the tighter time intervals. I just wanted to start off with the swing trading charts. I know a lot of you both do either day or swing. Some of you do both trading, so both styles. A lot of my guys do, and ladies do both styles. So anyway, gaps continue most of the time. Pay no attention to the moron educators out there that say, fade the gaps, sell the gap up. Seldom works out. There's specific exceptions, but most of the time, I always look to buy gaps up and sell gaps down. I'm a trend trader. So anyway, nice high volume gap. Took out new highs. We stay clear the day of the gap, but you start working into a trade the day after. And this is a good example of a gap continuation in Baker Hughes, the ticker, BHI. Here's another one, POM. This is one of my long calls for my traders. I told everyone to go long this thing back on, I think it was this day or that day. I said, if it breaks over that, it was 22.50 was my long call. Anyway, boom, shakalaka. He shoots, he scores, the crowd goes wild. This is a big gap up that kept running on up, right? This is a good continuation. Gap runner, POM, the ticker. That's one good signal. It's kind of like what Price was saying with that rocket ship takeoff. This is escapes the, I used to say, escapes the gravity well of the Earth's atmosphere, and it takes off. For you fellow sci-fi geeks out there, we like things like that. So here we have a narrow range. It was just May the 4th, which is Star Wars days a couple days ago. Anyway, I digress. Minor gap continuation. Here is SU, another good ticker. It's in the trough. We completely ignore anything that's in ranges. That's breakout trading 101. You never trade anything inside a range. Don't try and be the smart guy or lady that outguesses the market. Well, it's going down. And I see an RSI and stochastic and blah, blah, blah. So no, don't do that. Keep it simple. Just spray out a lot of trades on new highs if they have sufficient volatility and volume. So here's one, SU. I know Price had mentioned Whole Foods, and that one became more like half foods, bada boom, with its big gap down yesterday, right? Ka-ching, now that's a bullish lower shadow, so I wouldn't go short right now, but that one got cut in half. So I would much rather short this, by the way, at 36.50, just like my short calls in the social medias and Facebook and Twitter lately, because those have both gotten sold off sharply. Twitter being the most notable of the sell-offs, right? A good example, gaps down, continue down. Just classic trading. And I want to correct the mistakes, kind of like learning how to golf and correcting bad golf things that cause you to hook and slice. It takes a lot of rethinking of your approach, but just go in trend on your gaps. Here's another good example, ZU, the ticker. Another nice gap up, continue, kept running. That's nice. What I like about it is the fact we have a wide range candle at the right side of a cup. Now we have a spinning top / doji type pattern, bearish upper shadow. So when in doubt, stay out. I want you guys to write that down and think about it. When in doubt, stay out. Get in only if it breaks out, say, 50 cents over the next whole number high. Now, one of the first things that you want to do is and that goes through my example charts for tonight. Let me drill down now into a tighter time interval. One of the quick rules of thumb that can really help, save your trading life is use my 10% rule. And from a breakout volatility standpoint, this is an especially valuable point. You have my word on this. I've traded, and I prove I trade. I got brokerage, P&L, and scheduled these for my tax returns that I show traders. And you can see on my tradingtalk.com forum and all that. But the point is 10% low to high. So if this price is 60, what had the upper price range on a 15-day chart better be? We were looking at 90-day charts. Now we're going to go through 15-day charts because this is more the swing trading core that I use. I like to use the 90 days for top-down, 30,000-foot view to see if it's worth trading in the first place. Then I make specific entry decisions and disqualify or qualify the trade on the 15-day chart. Anyway, if this is 60, the price up here better be 66 or better. And from a beta or volatility standpoint, that's especially valuable as a technique. The reason is you don't want to trade something. I always pick on, I don't know, AT&T or Intel or Microsoft or other things I never trade in a million years because it's not worth trading. You want to trade things that actually have volatility and are able to move for you. So things that have at least a 10% range, for example, like this one, MNK is the ticker. It goes from 60, it should have at least a 10%. So 60 times 10% of 60 is 6, yields 66, and this is double that volatility. So that makes an especially better candidate for professional swing trades. Okay, now let me ask you a question. I kind of blazed through without covering this earlier, but in the interest of time, but here's a quick trade management tip, and then we'll look at a quick intro to day trading charts. My 30% rule is this. These are actual trades. This is $600 the hard way, okay? I did all these actual trades. Notice, please, mostly small size, itty-bitty size, up to a few hundred shares, but most of them itty-bitty size. Your challenge as a trader, and only real traders who actually trade could teach you this, which I am, and it is you need to figure out how to make, and this is, if you get nothing else from me in life, get this. You need to figure out how to make money, as a lot of the Chicago market floor traders do, being right, say 30% or less in terms of what percentage of your trades made money or not. And what that means is you have to have a more sensitive, dynamic, professional approach using position sizing or scaling. For more, you can learn from Van Tharp on scaling and position sizing and percent Rs and all that. But I was only right about 30% of the time, but I still took $660 net out of the market that day. A lot of these are overnight swings or swings that I was closing into a given day. Okay, this is scalping for small wins. My biggest stop was $40. My biggest win was only $170, yet I still made $660. Your challenge as a trader is to figure out the very strongest trend breakouts, which I do, even if you're wrong most of the time on a given day or a week, which you will have those days or weeks. You could still make money because you've scaled in properly. So this is kind of in the category of breakout trading for trade management. Or if you like to play things a little more aggressively, this is the example from a couple thousand shares of MGM I had held overnight and sold the gap up on the first sign of trouble and made a few grand in just two trades with the realized P&L that looks pretty good. Different ways to slice and dice. It doesn't have to be rocket science where you're going into a lot of detailed scalping. You want to get in where you're making some money in your trades. But don't worry about being right, half the time or 70 or 80% of the time. Most of my institutional clients, whether they're, they've come from, Chicago pits, or if they're from New York, the market makers or specs or whatever, those guys don't care about what percentage of their trades worked out. All they care about is how much money, their unrealized P&L that becomes realized P&L at the end of the day. And I encourage you to, to think about that in terms of my quote, successful trading is a lot more about the math, and the chart patterns really highlights that. So learn from Price, learn from me, combine what you've learned from us and figure out a plan that can do well for you. So let's see what else I have for you. I guess one of the things here is, let's take a look at, all these charts are not created equal. What are some of the nuances of breakouts that are better in some of these than others? Okay, let's do swing trading. Here's those same exact charts. Now we're going to go, instead of 90-day look at our 15-day chart. Minor gaps continue up. Remember that, right? Sometimes you'll get a gap fade, but usually minor gaps, if it's out of a congestion box, it'll usually continue up. So that's rule number one. Rule number two, use at least 30 to 50 cents above a cut pattern high to filter for a false breakout, because frequently get in. How many of you ever had this happen? You buy the first sign of a breakout because you don't want to miss it, and then it drops right down in the thing, you take a stop, and then it runs up without you. If you've been there, done that, got the t-shirt, if you do that a few thousand times and blow out a couple of trading accounts, which I've done, you have this come to whatever meeting with yourself and you realize, hey, there's got to be a better way. I got to figure out how to filter for false breakouts. So you don't want to buy things that are doing very sharp angle breakouts like this. Just as it moves up, as the world turns, it fades back down. If you see whole real bodies getting sequentially smaller in your candles, it's a little tough to see on this chart. You see a wide candle, a narrow candle, and then if you see two red opposing candles, that's an exit signal. Okay, we'll cover more in the upcoming event as well. These kind of trends are better. It has a nice steady 45-degree angle uptrend and good angle, good breakout. MNK is even better. It's a tighter breakout chart. SLCA, it's still hanging inside the range. The gap up did continue up though. So even if you got in, let's say you got in late to the party, it gapped up, you missed that, but it pulled back and bounced off that previous resistance, is now new support, and you got in on a pivot, still moved up for you a bit, right? This kind of chart is even better, DYN. You see the difference? A lot of, I've worked with thousands of traders, and one of the tens of thousands of traders now have, consumed my content and learned from me. A lot of traders will take a shot at a stock like this when instead there's better fish to fry out there like this one, right? Or better charts out there with steady uptrend, nice tight 45-degree angle breakouts, minor gap, yeah, pulled back, but I'd buy new highs in a heartbeat in this, 32.8, sure, I'd go long because it's a nice uptrend continuation. High volume, late in day, that's probably a news play, right? Continued, attracted new buyers, not for the day or two after the big move, but say day 3 or 4. And that's the beauty of using sitting buy stop orders, or I use buy stop limit orders in my accounts. So I don't have to babysit the thing. I might scale in. I might take a shot at it once. I'll take another shot at it, let it shake and bake, trail a stop at 1.5 under the inside market, and let the trade work out from there. So those are the type of charts you're willing to focus your energy on as a professional trader. In a preview for intraday trading, let me give you, guess what counts is, let's say, some of my actual alerts from my live room today. AIG, one of the things, that makes it worthwhile, let's say I told my guys to go long at 51.8. From a breakout momentum standpoint, again, this is, in this case, it was just 10 cents above the closing range. When it comes to momentum breakouts, you don't have to wait until the previous day's high, though that's my favorite signal, and what I told them to go long at 52.20, so that was the second long. But oftentimes use the closing range breakout. Everyone's talking about, Crable originated the concept of open range breakouts with commodities many years ago, long before other people copied him, just like I'm widely copied too. Anyway, the closing range is also something to pay attention to if you're a swing or a day trader. And you can often buy right outside of the last 15 to 30 minutes on a new high, 10 to 20 cents above the high, with a pilot trade to get started, even if that's under previous resistance, because the momentum, if you're confirming it with tape reading, and I don't have time for tape reading tonight, but if you see a strong tape, there's signals you look for. The tape reading breakout as things are moving quickly in market that I teach traders about, that's the type of entry signal to do a pilot or test trade. one of the challenges that a lot of traders face, and I'm remembering back to the 90s, back I was one of the original .com day traders before I was copied, and my university site concepts were copied, and I was just widely copied out there. But the point is, I used to do, say, 300 shares all in or not for breakouts if I was trading, say Qualcomm or any of the other high flyers, or DoubleClick or Yahoo or whatever back in the 90s. That's not the right way to trade. That's the right way to give a lot of money back to the market and lose. So the right way to trade is be ultra skeptical of everything. Be a cynic. Be a skeptic. Expect every single chart's going to screw you at the first chance it can get, as though the trading powers that be have it in for you. That's a good, healthy, skeptical attitude. Okay, so the countermeasure is look for the very strongest uptrend continuations, but still use really tight size. Take real small stops when you're wrong. If you get hosed in a trade, make it cost you, 5, 10, 20, 30 bucks, 40 bucks on the outside. You could still make money potentially doing that correctly. So use a much tighter granularity in terms of your trading approach than you may have been exposed to. You should never be trading 1,000 shares of an underlying. That's one thing what's good about options is you can hedge and you can get better leverage, and you don't have to put it as much at risk. And that's one of the reasons I'm excited to be working with Price Headley, one of the top options guy in the world, to teach you guys how to use a good professional breakout strategy combined with very tight, careful risk management. And here's another one. What was this? Solar City. The solars have been hot lately. Boom. That's an inside joke. Anyway, I told my guys to go, what was it long? 5120. Those are my long calls today. 5120 live in real-time markets. 5230, 5430. We're just hammering away at this thing. And the last call was 5470. And I got them out on one of these pivots. I forgot which one. I think it was this pivot on the first two red candles. Anyway, as you're looking at scaling in on breakouts, one of the things you're looking for is high volume breakouts accompanied by, and I was telling my guys, this is a minor gap continuation. It's an inside range gap, not my favorite. My favorite gaps are above previous day's high, also known as out plays in the market. Out days are days in which the S&P or the E-minis, whatever you're trading, the market indices are outside the previous day's high low. Those are the best trades to take. But this was still a gap, and that caught my attention. That's why I started telling my guys to work in long on their day trades on a, in this case, it was a pivot continuation play because of this previous high. Now, what told me this would be a good long? Well, at the first sign of, I use that cup pattern. There's a bearish cup. There's a bullish cup, resistance. I knew that we'd want to scale in at the first sign of a breakout above that, right? And so this is a minor gap. I like to buy gaps in trend, even on day trades. So a minor gap up, we start working in on long. So anyway, those were some calls on intraday. We'll go in a little bit more on day trading and scalping in the upcoming session to be continued. But, these are some of the best of the strategies and some of the very strongest of the plays out there that I encourage you guys to start getting your head around. The two biggest challenges that traders have is, number one, you guys take grievously large stops. Stop losses should never be more than a couple $100 ever in this life. You should never, if you're taking stop losses more than a couple $100, something's woefully wrong and you're not long for this trading life. What you want to do is play it tight, play it very careful, take more shots at the market on tighter size, because I don't care if I'm right or wrong, I could still be right only 30%. This is an exceptionally bad percentage right day, but still is 30% right, 70% wrong, and still manage to pull money out of the market. That saving grace, or that approach, is really important. And then you can save up for your swing trades and scale in. So I've got 60 seconds left, and then I'll open it up to price as well. For those of you who are new to working with me, you might want to check out some of my from Price Ain't Half Foods. Yeah, that was, I come up with all these jokes. It's fun. There's my YouTube videos, and what else? If you want to get on my Saturday Trading Week Ahead events, we're up to almost 3,000 registered for this Saturday. It's the biggest turnout or biggest registered numbers I've seen on an ongoing basis in the whole industry. I get more single-handedly on Saturdays than most of these multi-speaker shindigs do, because they're only 20 minutes. We like to hit and run stocks, ETFs, E-minis, and Forex. If you want to learn more, you can just go to daytradinguniversity.com and just click on this up here, right? So anyway, and that's the go-to meeting for the Saturday event. So That's it. And there's my YouTube channel. It's a good way to get a lot of free content, see lots of video testimonials and all that, just to get familiar with me. On another thing, too, I publish regularly for equities.com, which is a good online magazine. You can see a lot of free articles, too. So anyway, that's it for me, and I wanted to thank all of you on behalf of Price and myself for being here with us in this evening's fast-paced 60-minute event. And by the way, let me ask you guys, do you like this format better or not so much? I know sometimes you've got these grievously boring PowerPoint pitch fest BS from these educators who aren't even real traders. And don't get me started, right? These guys do these moron 4-hour epic fails where it's boring the living blank out of. I can't even stick around. I'll stick around 5 minutes and then I'm out. So I like to go fast and furious. I'm a professional day trader and swing trader. Do you guys like this format where it's like 30 minutes? So you get two of us for the price of one, or free for two of us free for the price of one in this case. But 30 minutes, kind of hit and run, give you guys a lot of good nuggets to think about. Hey, thanks. Thanks, Sam and Cliff and John and Domingo and Rian and AR and Murray and Neil and Catherine and Don and DM and Jerome. You guys are saying yes, great. Let's see.
Ken, my favorite there is Paul said it wakes me up. So, that's exciting.
Yeah.
Like keep people energized. It was a lot of fun, and obviously for a couple of people that maybe came in late, it might have been, kind of trying to pick it up midstream. But I do agree. I mean, Ken, as you all saw, Ken just gave you great content, real world stuff, things that he's doing right now. I did the same, and so we had a lot of fun here, and that's why we're going to do it again here. So you folks are all going to want to stay tuned, definitely to be continued here May 15th. And Ken, I just can't say enough about how great your presentation was. I was getting some good chuckles about your jokes. I hadn't heard half foods, but you nailed it. It was a big flip on that stock here the other day, and I agree. I see what I see, Ken, is that there's so many synchronicities in what you're doing and what I'm doing that basically, we might call it somewhat different things or have slightly different tweaks to what is the same basic philosophy, which is stay with your winners, get the most out of your best ideas, catch them in the right spot, and trail your stops. And like you said, don't take big losses, control your risk, and that keeps you in the game for the long haul. And so I see a lot of similarities in our philosophies, which is why I was so excited to work with you tonight and on a variety of things going forward.
Yeah, thanks so much. Yeah, I like the synergy too, or synchronicity, which is a good song by the Police too, or Whole Foods, also known as Whole Paycheck. But don't get me started.
That's
it's
right.
expensive, but worth it. If you want a vegetable juice and greens, it's good for your body. Anyway, but yeah, a lot of synergy, and I really like, for example, the William percent overbought you buy, just like ADX, I buy. We're always about isolating and trading the strongest big trends out there and the best breakouts. And so you're the other best breakout guy I know out there. So thanks so much for working with me, Price. Look forward to be continue to work with you in our next event coming up a week from tonight. Same bat place, same bat channel. Stay tuned for more, and we'll get this out to you guys later. So thanks, Price, for being here, and thanks all of you. All the nice comments from all the traders. You guys are saying so many kind things. I appreciate it. So.
Yeah, thanks again, Ken, and then great stuff. Thanks, everybody, for being with us, and we will definitely follow up with you here in the coming days and look for that invite for the next week, in addition to all the other new people that are going to be in, because we jammed up the room pretty well here with a big crowd, and we will have more to come next week, same time and same place. So look for it then. Thanks again, Ken. Keep trading well, and we'll see you again next week.
Okay, thanks so much, Price. It's been a pleasure. You're one of the best out there, so thanks for working with me. And thanks to all you hundreds of traders for being here. Appreciate it, guys and ladies. So we'll see you next week. Bye-bye.